Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner. Welcome back to the show, everyone. Today we have Jonny Cattani, and if you've been listening to the show for a while, you know that Jonny was on episode 13, so definitely want to go back and listen to that when you get a chance. But Jonny is the first repeat guest on Real Estate Milestones, which is an awesome way to commemorate the new year. So I'm excited to have you on the show, Jonny.
Hey, grateful to be here and honored to be the first repeat guest. We have both come a long way since we last spoke, so looking forward to catching up.
Yeah, it's an honor, and I'm excited to talk about progress since then and see where we're going from here. But so if you hadn't seen the last episode, Jonny is the founder of Cattani Capital Group, which is a fund of funds manager which raises capital and puts the capital into other funds. And it's a really interesting strategy. You should definitely check out episode 13 because the fund of funds strategy is a really cool way of entering the real estate field. But he's also the host of a podcast, which is changing its name. So what's the name of your podcast, the new name? And I think this is the first chance you get to reveal it on someone else's podcast. So excited.
Yeah, you're right. It is. Yeah. So the new name of the podcast will be the Cash Flow Chronicles.
Awesome. I think that was different than the one that you announced last time.
Yeah, it's possible. There were a few, and then I landed on one where I thought I was being clever with this last name, but it ended up being too difficult and doesn't really encapsulate what I want to focus on. So full rebrand, but it's the right decision.
Yeah, Cash Flow Chronicles. If I could say it, I think it's a really good name. But
right.
I'm one of the few people who got IRR, the Investor Relations Real Estate Podcast. Yes. I liked that. I thought it was clever.
I thought so too. But unfortunately, that doesn't equate to more investors when you're clever. So, making it a little bit more clear cut is actually, what the ultimate goal is. So thanks to my podcast coach for pointing me in the right direction, and I'm looking forward to the new direction.
Awesome. Well, on that, since you're the first repeat guest, you're the first person to get this question. Rather than what's your first milestone in real estate, which we heard on the last show, what's your latest milestone in real estate?
Yeah, so pretty cool that I get to say that my latest milestone is a step in the direction. I've finished, so I'll say what it is. My latest milestone, literally as of like 5 days ago, was I finally finished my first official capital raise under the Cattani Capital Group name. We did fall short of what I said I would raise on your first episode, and also fell short of what I told the group I would raise. However, it wasn't nothing, right? We raised 150,000, or I raised 150,000, scratched and clawed to 150,000. Which was unfortunately short of my 500K mark, but as we'll get into, a lot of very valuable lessons learned for sure.
Yeah, definitely. And I think that, I definitely want to learn about the struggle, what you've learned. And I think that's the biggest thing that you can get from any experience is really the personal growth and your ability to, in the future, use what you learned to accomplish your goals. And I think that, that's something that needs to be celebrated. So I'm excited to hear. So yeah, let's get right into it. Tell me about the experience. I just want to hear about your first capital raise. How did it go? Just walk us through it, and then we'll see what lessons come from it from there.
Yeah, so it went well. Ultimately, like I said, fell short of my mark. I think one of the biggest things that I realized, and I know a lot of first-time capital raisers or people who have raised capital can probably say this about their first time, but I came up with a conservative number based on how much money I knew I had access to. The issue is that having access to and actually getting that money wired and actually, PPM signed and money in an account are two very different things, right? So there are still some big check writers in my network that I've not done a deal with for good reason. Right? It's just kind of a track record thing, and ultimately they weren't looking for any passive deals, which this last raise was that, right? It was a fund for a short-term rental portfolio, the top private short-term rental portfolio out there. So really, really solid operator, great deal. But ultimately what I found is that not as many people as I thought were looking for passive investing. And so it, brought its own challenges there, which was kind of the big reason that I fell short, because the people that I thought would be writing the six-figure checks ultimately did not. But I was able to get some family and friends in on their first deal. So, although I did fall short of my mark, it feels so awesome to start to get some proof of concept going. One of the investors is my dad, which I'm really excited about. As he's getting older and kind of starting, really wants to start focusing on getting close to retirement. It's cool to help him, get going in that and help him understand how it works. And there'll be some passive income here rolling in shortly in the next quarter or so. So a lot of really awesome things to look forward to as well. So.
Yeah, definitely. So can you tell us about the deal? Like I guess pitch us on the deal. Why would we invest in that deal that you just raised for? I just wanted to hear kind of how it fits into a thesis, and it sounds pretty interesting in terms of what it consists of.
Totally. So I won't get into the specifics. It is a 506B, and I'm almost positive now that we're like close. I can talk about it, but still have not chatted with my attorney yet to confirm that. So I won't say the exact operator's name, but I will give some of the details. So like I said, it's a short-term rental portfolio, but there's already 70 plus short-term rentals in the portfolio. It's a very data-driven approach. So, it's not just a shotgun, buy houses all over the place. It's very much using data to find the best markets where you can give the best experience. So for example, let's say you're taking a trip to Disney World in Orlando, right? Instead of, going and certainly you could go and you could stay at a Disney hotel and certainly that would be an experience. But let's say you're also doing Universal, right? And also going to maybe Star Wars or Harry Potter land. Well, there are houses in the portfolio where you can go and stay in a themed house where each room is, not just painted with Star Wars, but like a Star Wars bed that looks like, Millennium Falcon cockpit, right? These very niche experience short-term rentals that allow you to charge a premium, because what the data finds is that people are willing to pay a premium for that experience. And certainly on the other side of that, to kind of hedge that, there are some more, urban markets, right? So like, for instance, Memphis is a very, very heavy medically focused city. A lot of doctors and nurses come in on short-term contracts. So you've got urban places as well to kind of hedge that. So it's a very balanced portfolio between, providing a unique experience as well as, very useful and strategic approach as well in some of the urban markets. So that's kind of the approach in a nutshell. And all of this is using data. And what's really cool is, for the first time, what you're seeing a retail asset. What I mean by that is, typically, your average person maybe has one, maybe two short-term rentals in their portfolio, right? Maybe they have more, right? Maybe they have 5 or 6, but they're all, going to probably be very close to each other, right? Make it easy to manage. Well, with this, what they've done is they've built a proprietary software that allows them to constantly be analyzing all of their markets, all of the data for short-term rentals in that market, as well as all of the MLS listings in that market, so that when they go for acquisition, they're actually buying a residential home on a comp, just like, you would go out and buy your main residence. And then from there, turning it into a commercial product and using data to decide what the best design is, how to make it as unique as possible for the market to get the most revenue possible. And then from there, it now has turned into a commercial property. And what we're able to do is take all of this, and eventually the exit plan is either to sell, plan A is to sell the entire portfolio as a whole to an institution, but it can also be sectioned off and sold to institutions as well. So essentially taking a residential and retail product and now making it a commercial product that trades on a cap rate, which, automatically increases value.
Absolutely. And especially the pooling aspect, it offers the diversification within the portfolio, and also that single check size for the institution on the buy, right? They can just sign the $100 million check versus having to buy all these different houses, where that's where someone like you and your operating group has a strategic advantage, because you can do that versus having to be the high level. Oh, we like short-term rentals, we want to be in this market. It's much harder to actually do it on the individual level. So that's a really powerful strategy. I definitely subscribe to that line of thinking, and I like the logic there. You also got ahead of my next question, would be, if it's experiential, what happens in a recession when there is maybe travel is less attractive. However, the skilled nursing aspect is definitely one of the biggest keys that I didn't realize at first. But I guess people like skilled nursing, traveling doctors, traveling medical staff, that's a huge market for Airbnb, which I didn't realize. So that's really interesting. I guess coming on that theme, what do you see as, or can you kind of highlight your thinking in terms of the recessionary pressure we're feeling? How is the market changing from your perspective, and how is that affecting your business? And what are you thinking about that?
Yeah, totally. I mean, it's a very valid question. Again, right, when having this data first approach, what you're actually seeing in the data is that, obviously there was a huge drop off during COVID, right? Of course, everything experienced that. And then what you saw was this massive just rocket ship from all this pent up traveling demand. And what you're actually seeing now is you're actually seeing the cooling off period happening right now. Certainly, a lot of economists, I even think that this next year is going to be a much slower year, right? Interest rates are up. The Fed's kind of made their plan clear. They jacked them up really quickly. Sounds like potentially another one coming here, maybe Q1. And then sounds like they're just going to wait and see what happens. Now, a lot of things happening globally, right? We're seeing potential collapse in digital currency. So there's a lot of pressures and things that we've never seen before, right? This isn't the 80s where interest rates are the only, up at 12, 15, 18%, but that's it, right? There's all these kind of little nuanced sort of variables at play, and no one really knows which one's going to be the straw that breaks the camel's back. But certainly, depending on which data sets you subscribe to, it does look like something's got to break somewhere. That's usually how our recessions go. And so when it comes to the portfolio, this is what I tell people. It's going to be like anything else, right? It's going to start with your debt, right? And so I'll get into that and our debt approach and why we have safe debt. And then it's going to come down to your economies of scale, right? So start first with the debt. Debt is so crucial at all times, even if you're in a bull market, staying, keeping your LTV low, right? Your loan to value, right? Staying at that 70% or even, even lower mark. And so for us, for the operator, what they've done is they're getting all fixed rate, 10-year fixed rate debt, right? With usually a 2 to 5 year interest only payment plan. So you're getting really safe debt that allows for, an increase in, potentially we have to hold longer, right? The hold period's 3 to 5 years. So, we're obviously going to assess things in 3 years, but certainly if we have to hold, that's well within, what we're looking at, as well as if we do get to that 5, even 7-year mark, we're still not at the end of our interest rate. And even if that did come, they're still on, 30-year, even some are on a 40-year AM. So very, very smart debt, very good loan to value. That's the first key. And that's what I like to pay attention to, and why I jumped on board with this, because, certainly something is coming somewhere with the economy. And by having that good debt, it also allows us to, turn them into medium or even long-term rentals if need be, right? So kind of a few levers we have to pull just by having good debt. And the number two thing is the economies of scale, right? This isn't a 1 to even 10 door portfolio, right? We're at, I believe, at least 70, if not closer to 75 now. So what that gives you is economies of scale, which allows for, if, a certain market is not doing as well, you've got these other markets like Scottsdale and Memphis and your Florida markets that are strong economically, no matter what's happening, that can carry you through. And, listen, this is real estate, right? It's ultimately, subjectively, probably one of the safer, more stable asset classes to invest in. And so ultimately we're going to be fine in the long run. If you have to take a down year, maybe there's a down 18 months, that's just how it's going to go sometimes, but that doesn't mean it's a bad deal. That's why there's a 3 to 5 year hold period. And that's why, you have different levers. And ultimately, in the end, what you're telling your investors is, hey, this is what your average rate of return is going to be over the life of the deal. And, this is your equity multiple over the life of the deal, right? So you've got to give it that time. And ultimately, who knows? Best case scenario, it's just a small little blip, and, we cruise right through the year. So who knows?
Absolutely. And I think that I want to linger on the debt component, because just how crucial it is that, maybe in the short run, your value comes down, and maybe your cash flow even comes down a little bit too. The key to the debt component is that in the long run, as long as you're not forced to sell at the bottom, it will come back up in the future. Or at least I strongly believe that in 3 years or 5 years, even, interest rates will definitely be coming back down as the, Fed loosens up, values will come back up. And given that, as long as you weren't forced to sell in that, 1 year from now, or, 18 months from now, you'll be fine on the other side of it, which is really the key. That, I guess the people who lose in real estate are the people who have to sell because they took on risky debt, or because of some other component, some other risk. And then that's why they lost so much value, because they had to sell at a bottom, which I guess is also going to be an opportunity for other people to get into the market. I'm just given how much short-term debt was taken on in the last year or two. If rates are still high, how are they going to refinance into long-term debt? How are they going to, get the capital from their investors to put money back in for that long-term debt? So that's when people are going to be forced to sell. So that's a really strong component. And I think that that's why, deal like the one that you're involved with is the kind of deal I want to be in this kind of market.
Yeah, absolutely. I totally agree, right? Debt to me is like the most important thing. And everyone always wants to talk about the returns, and of course, good return profile and good economics as an investor. And even, if you're on the operation side, obviously very important, right? Certainly, we want to try to maximize that. But especially in these times, like you said, the ones who go down are the ones who over leverage, right? You're 80, 90% LTV. What you're really going to start seeing, you're going to see a lot of like fix and flippers are starting to have a lot of houses stay on the market. Of course, we know they're on, getting crushed by hard money, right? And if they have to extend, then that's going to mean points in the long run, as well as, those are getting up 9, 12, 15% now. So you're going to see a lot of opportunity potentially in the short-term rental space, even to acquire some houses on a, on a really solid discount, especially because they're being sold on a comp basis, right? A fix and flipper is just going to use comps to sell a house, which is then going to allow us to potentially take on a house that's, already been rehabbed, and of course, maybe get some instant value, as well as, of course, on the commercial side, like you mentioned, a lot of bridge debt was used in the last couple of years for a lot of these operators who were just trying to get in and start doing deals. And so you're going to see a lot of opportunity over the next 12 to 18 months for those who are positioned well, which goes back to the economies of scale and having good debt and always, using good leverage. If your portfolio is set up for that and you're good, you're licking your chops right now, because it's going to be a really good 12 to 18, even 24 months. For new investors, if you're new, this is the time, right? Learn now, because if you can learn how to do deals now, when we come out of this and hit the bull run, you're going to just have so much momentum.
Yeah, absolutely. And so I'm curious, is this fund like an evergreen fund where you're continuing to acquire? Like, how do you have the capital to continue to make new investments? And, are people who are buying into the fund buying into the existing investments? Just how does that work from a structural standpoint?
Yeah. So the fund it's interesting how it works. So as of 5 days ago, our fund is now closed for the year. If we wanted to do a new fund, we'd actually have to open up a whole new fund LLC, just the way it works with compliance. However, how the operator works is they have, if I remember correctly, there's 5 or 6 entry points throughout the year. So starting next year, they raise money directly, as well as they're very obviously fund friendly. So there'll be openings throughout the year where you can start a fund, bring in your investors into that opening, and then, they're essentially taking it and just chopping it all up. And you're not buying actual interest in the homes, although you do actually get a discount as an investor at any of the locations, but you're not actually owning. You're just a straight passive investor, limited partner. So no ownership, but in return you get, very nice return, preferred return, as well as something that's pretty rare is a really nice equity multiple as well at the end. So.
Awesome. Cool. So, I'm curious in terms of just a little more about, what were the challenges with raising capital, but more importantly, what are you going to do going forward? What's the biggest lessons that you learned, and how is it going to impact your future, in this business?
Yeah, absolutely. Great question. So first thing is I put too much, like I said earlier, I put a little too much equity, pun intended, into thinking that my close network that I talked to constantly would just, because I talked to them, because I knew there were people in there who could invest, who had money, I thought that they just would, right? And I grossly misunderestimated that, which is a great lesson. That means that I did not get in front of nearly enough people, right? My list is not nearly big enough. I need to at least 10x my list over the next year. So that's a big thing. So what that's going to look like is, starting to go to and be a part of more local RIAs and virtual things where, I'm ideally one of, if not the only commercial guy in the room. So, a lot of people here in Salt Lake City love wholesaling and fix and flipping. So a lot of the meetups are wholesalers and fix and flippers. So by showing my face and being that guy, as they start to kind of understand the economies of scale and what they're doing is very transactional, hopefully they'll, maybe want to diversify and get some passive income going, right? As well as, I've identified my niche as, creators and influencers and busy millennials. Well, sure, those people do go to real estate conferences, but not really, right? They go to, tech conferences and, entrepreneur conferences and creator conferences where the top influencers in the spaces are speaking, right? So it's about going and getting a booth and sponsoring those where my avatar hangs out, and getting in front of them and being a lot more proactive about getting in front of people. And then there's some internal things. I'm going to switch up my lead magnet and, start getting a little bit better organization funnels and things like that. So really, really good lesson in that, just because people have money does not mean they're going to invest with you, which means you need to get in front of as many people as possible, but not just shotgun approach, right? You need to identify where your avatar is and then figure out where they are and then get in front of as many of them as possible.
Absolutely. I know Hunter's first story of his first capital raise sounds something a little similar in terms of that, but that, something that he said to me that encapsulate this message that really sticks out to me was that, there's going to be people who would let you babysit their kids but wouldn't let you, wouldn't invest their money with you just because it's it seems like you need more trust to babysit a kid, but it's just kind of a different thing. It's a different kind of relationship. It's just a different part of your brain, maybe even. It's just it takes more to invest, and people work hard for their money and they want to be very sure about what's happening with it.
Absolutely. Yeah, it really is know, like, and trust. And, it's ironic. This business, especially capital raising, is so challenging because so much of it revolves around your track record, but you can't get a track record until people are willing to take a chance on you, right? Which is why you typically start with your friends and family, but that can also be the most challenging, right? Because, it almost feels like there's more pressure for the deal to be right, in terms of going correctly, right? You don't want to take of course, you never want a deal to go bad, but if you do enough, there's probably going to be some misses. And, when you're getting your friends and family involved, certainly that's in the back of your mind. It makes it a little bit more challenging to have those conversations, but ultimately, they're probably a little bit more little easily persuaded than, even being, twice, 3 times removed. So, the biggest thing is going to be referrals. And what'll be nice is as this deal starts to really, the dividends start to be paid and, more and more, direct effect to my investors starts to happen. It'll make getting new investors easier because that's more content for me to talk about and more data points for me to show people like, hey, this is what I've been able to do for my investors. So it's this weird catch-22 in the beginning where you're like battling so hard to get that track record. But the art of the first deal, man, once it starts rolling, it's like, I just know next year is just going to start snowballing.
Absolutely. And it's the chicken or the chicken before the egg.
Oh, man.
What comes
Totally.
first. And yeah, so it makes a lot of sense. So I always thought about that too in terms of starting out for myself. It's that, there's 2 parts from what you just said. It's like my biggest fear for starting out with friends and family money is that, yeah, maybe they're more willing to give to me, but I'm more worried about losing it because it's like there's so much more, the stakes are even higher. And so it's like, yeah, sometimes like there's risks in every deal. What you're trying to do in the long run is diversify and be in many different deals. So when something goes wrong with one of them, it's okay because it's bound to happen at some point. The issue is if that's your first deal, that's 100% of your invested capital. So that's like a whole nother story. So that's definitely some fear that I had. And part of the reason why I feel like when I start raising capital, I'd want to do it with, and I mean, I guess the key to overcoming that is being really good at vetting the sponsors and understanding what you're getting into. That would be the best way to overcome that. And being able to identify good deals. However, that's a skill that you learn too as you progress. So it's an interesting catch-22, as you said, and definitely a reason why I guess the way I'm looking to get it started is find someone with a lot of experience to partner with, leverage someone else's track record. And I think that's going to be the entry point where I'm comfortable and also confident in my success.
Totally. Yeah. I mean, that you have to. This is such a team sport that, I'm super, super grateful that I have incredible partners who have been doing this, who took a chance with me, knowing it was my first raise, knowing I'd probably come up short. They pretty much covered what they said they would. So really, really great partners, super grateful for them, which is a huge key. The other key is doing small things along the way, right? If you're just starting out, house hacking or, doing little things to build up your track record. Maybe you have a duplex and, or, if you're already a high income earner and you're really interested in passive investing or really interested in capital raising, go do 2 or 3 passive deals, right? Maybe, start now, maybe find a couple, 2 or 3 next year. And then in a year from then, you've got actual proven concept of, hey, look, found these great sponsors. Here's my return so far. And you've got hard proof that it works. Then people are actually going to be willing to listen to you. So those are a couple ways a lot of people get started. Certainly don't, I shouldn't say I don't advise it, but it is more challenging to be doing your first few deals and trying to raise for them as well. However, it's not impossible. So, just a little more challenging.
Yeah, absolutely. So, I remember hearing you talk about adjusting your niche, and that you were thinking about going for, as you mentioned, millennials and people, busy younger professionals closer to, I guess, your demographic that you may know, understand. So I'm curious how, you decided on your niche, like what went into that. How much your focus is really on your niche, and where are you finding them? I know you mentioned TikTok, which I think makes a lot of sense, but I'm curious, like, what's your strategy going forward?
Yeah. So, it really is going to be to double down on social media. So going to be a lot more, really taking my personal account and making it just all about business, just really, propping myself up to, be an expert, right? In the field of, not teaching capital raising, but teaching passive investing and how these, of course, busy professionals my age, but also these content creators and influencers who don't have the time to do the research and find good deals, but are high income earners, right? And, even these management companies that are out there managing these very talented creators and influencers aren't offering any kind of, retirement or insurance or anything like that. Now, I'm not going to get into the management side of things, but what I'd like to do is offer that approach, right? So yes, certainly starting with the influencers and the creators themselves, but eventually working my way up to, partnering with entire management groups and helping bring the private placement world to these, to this demographic of people that just doesn't have access to that information. I didn't have access to it. If I didn't just stumble upon syndications through books and podcasts, I would never know about it. And, I'm sure a lot of people can say the same thing. And so what I've identified is that, by getting on social media and hitting social media hard, I can get in front of these people and show them that there's this place out there that you can take your income and invest it so that it's working for you, so that you don't, if for instance, something happens and you can no longer make content, or, maybe your run comes to an end and you're no longer, a viable influencer in your space. Like, of course, I hope none of this happens, but these are all real possibilities. And so by, bringing them good deals and good passive opportunities, they can start building that wealth on the side, outside of 401ks and all this, the public sector.
Absolutely. I feel like as a content creator, I guess, I like what I do, and it's a lot of fun, but it's definitely a lot of work. It could get tiring. I wonder if a good messaging would be, do you ever want to just sit on the couch and not make a TikTok today, or, whatever? You ever get tired of doing this every day? What if you could just still be making money even when you're not creating content, right? And so it's now every time you create content, it's because you love it and not because you have to do it to pay the bills. You got something else making money. I think that's the messaging that really would resonate.
Absolutely. Yeah, you nailed it.
Cool. So this last question for the lightning round is,
Yep.
what is your goal for 2023 or going forward? What's your next milestone that we're gonna hit? And then when we have a podcast next year, we're gonna hit this one.
Yeah. So the goal is to cross the $1 million mark. So as of, end of next year, have raised a total of $1 million, which, I pretty much have the whole chunk to make. So next year we'll be really, really focused on getting in front of as many people as possible and not trying to milk, certainly still, friends and family, of course, but really trying to get in front of more eyes so that, you obviously, right, build my list and not rely so heavily on the few in my network who could probably write big checks. And in return, that will, ultimately allow me to do more deals and raise more capital. So it's really about getting in front of more eyes and, kind of honing my message in. I kind of took a shotgun approach this last year, right? Didn't really have everything dialed, probably put some energy in some places I didn't need to. So now, for this next year, it'll be a lot more strategic and really building my list and getting in front of the right people.
Absolutely. And something I'm excited about for you is I could only this is just something that started turning my mind. I could only imagine how incredible the network effect would be in the influencer space. And if one influencer is has a referral and they talk about you once on their TikTok, I can only imagine how many influencers watch other influencers and how fast that messaging could spread. So actually super bullish on the influencer space. Something that's very necessary in terms of, especially if someone just started being an influencer without, I guess the traditional education, or even with traditional education, there's not much financial education, which is something that you could be the voice of, which is,
and that's the biggest thing, right? Is providing that education, but like you said, right, that tailored content that speaks to them, right? So that's going to be my biggest thing is of course, getting in front of them, right, and change up my content, but also providing that education. So currently working on a big educational platform and kind of some different lead magnets and things to really speak to them and then ultimately be able to educate them and hopefully obviously bring them in as an investor, but ultimately, help them create that wealth and build that passive income stream. And like you said, where one goes, hopefully more will follow.
Absolutely. So ready for the lightning round 2.0?
Let's do it.
Awesome. So since he's already did the first lightning round, we're adapting it. This is the second edition for everyone who's listening. So to start, a question that I love, given my background and my family's interests, I wanted to start with asking, what is your favorite, or who is your favorite musician, or who's your favorite band?
Ooh, favorite musician. Oh, that's a really, really good question, man. Okay, this has to be quick. I'm trying to think. Gosh. So this is gonna age me, but there was a time when Lil Wayne was I thought the best rapper alive. So that's the first one that comes to mind, only because I just was on a trip with a bunch of people my age, and we were reminiscing on the rap we listened to in high school. So it's fresh on my mind. So I'll have to go with Lil Wayne.
Yeah, I don't think it ages you too much. I mean, first of all,
Well,
it's
he just
crowd
kind of
pleaser.
fell off. So
Well, yeah, I mean, he's I'd say retiring or just kind of, spending his time doing the things that you want to do when you retire, hopefully. But
totally
so he crowd pleaser though, because he's a New Orleans native, and everyone listening from Tulane loves Lil Wayne, and I went to Louisiana. That's his festival in New Orleans he does every year. It was great.
sweet.
Um, so what is another book recommendation? Last time you're on, you suggested Influence is Your Superpower and 10X Rule, but I want to hear another one.
Yeah, a really good one is Principles, Ray Dalio.
Awesome. That's a good
That
one.
quickly became my favorite book.
Yeah, I've read the new Principles as well. That was a great one.
Yeah, I have that one as well, but I have not started. Changing World Order, I think.
Yeah, that one's great. You should definitely check that one out. So much data in terms of data driven philosophy. It's like completely a mind meld between a computer and a brain, and then just
Yeah.
like coming up with great stuff. It's amazing. So if you could travel back in time, where would you go and what would you do?
Ooh, that's a good question. So I am kind of a secret history buff, and more specifically World War II. And I know it was a terrible time in global history, but man, to experience some of those, to be able to witness some of the events that took place that are so fascinating, and even some of the controversial ones. I think what I'd really love is I'd love to be able to go back and see some of the ones that are like, you know, new released, top secret files, and really see how certain events actually happen compared to maybe what we've been told.
Yeah, it's hard. History is written by the winner. I guess that's
Correct.
it's just there's inherently a bias when we're reminiscing. So yeah,
Exactly.
it would be cool to see things firsthand. Being said, I'd love to go back and hang out with Aristotle and Socrates and Plato. Honestly, I want to hang out with Socrates because he hasn't written anything. I want to see him firsthand.
Yeah,
Um,
and I would be like even like Beethoven too, just to go back and just listen live. Like, oh man, I played the
yeah, I mean,
piano all growing up, so I
that'd be
was a big
crazy.
Beethoven fan.
That's awesome. So, in 100 years, I'm in 100 years, right? When you look back on your life, how will you know that it was a success? What is your success criteria? What, looking back, how do you know that you lived a good life?
It's gonna be based on the effect and change that I left on the world. Is really, and if you would ask me, and maybe you did ask me, and I had a different answer, but certainly after this year, it's really going to be based on the amount of people that whose lives I was able to change, hopefully for the better, of course, right? But really, that's my biggest thing is I want to leave an impact.
Absolutely. And just to make sure you didn't forget, we got Man Up, the foundation for fighting men's mental illness. And I'm going to be on the board because it came up with the
Still have
name.
not forgotten. Still have not forgotten. We're getting closer. I think that's probably a 3 to 5 year, more realistically. Now that I know how hard it is just to do one business, don't want to spread myself too thin, but have not forgotten. So that's definitely going to be a thing for sure.
Absolutely. Can't wait. It's a good goal. And lastly, as always, since I put you on the spot, I want to give you a chance for revenge. So what's a question you have for me?
Oh man, I forgot you do this. Gosh, this one's tough. Let's see. Last time I asked where you were studying, but now I know. All right. How many real estate deals have you done?
I haven't done any deals
Okay, so
myself
when are you going to do
yet.
your first deal?
Hopefully next year. I'm hoping when I move um out of college. Definitely part of my plan is to house hack a fourplex wherever I end up living. I'm excited about doing that. But I'm hopefully I'll have the opportunity to partner with a more experienced operator where I could bring my financial knowledge, my ability to model, my grind mindset, my hard work, and my ability to talk to people. Bring these skills to a partnership and do a deal with someone who's done it before, and hopefully have my friends and family and people who are in my network who have learned that I have seen what I've done over the last year at the podcast and have learned to trust my expertise in some respect, and my judgment will be able to start their passive investing career with me, and that would be awesome. That's the first step on the vision. So
I love
that's where
it.
I'm hoping to
If
go.
you house hack a fourplex and because between your copyright and underwriting skills, that brings a ton of value. If you house hacked a fourplex and then went into a partnership and, started underwriting, you would be able to, your track record would be like, boom, instant, where you'd be like, hey, look what I'm doing. I've got this fourplex and, I joined forces and we're going to go take on this 20plex. People would, between the podcast and everything, people will absolutely take you seriously.
Well, appreciate that. And I'm hoping that's the case. And I believe it. Definitely just having a year-long podcast is like, at minimum, I've talked to at least 52 experts in real estate, and whatever you can learn from 52 hours of education, plus whatever you think went into it, plus, everything I've listened for copywriting, definitely racking up a lot of, I guess, knowledge. It's definitely absorbing. So excited to put to work.
Awesome. Love it.
Cool. So where can people find you nowadays? I know you're out on social media, but where should people go to learn more about what you got going on and see and stay in touch with what deals you have in the future?
Yeah, absolutely. So honestly, the best place to follow and chat with me is on Instagram. You can follow me at Jonny Cattani, JONNY CATTANI. You can also search passive income expert. I'll come up with that search as well. You can also get on my list. Currently right now, what I'm offering is a free ebook. It is Commercial Real Estate Recession Proof. Full disclosure, I wrote it last January, which hilariously enough was the top of the market. There is some good data in there, but it's just really long. So I don't expect anyone to read it. However, what that will do is that will automatically get you on my list, and you will be the first to know, because my list is going to be the first to get access to all the new content and education that I'm coming out with before I release it to the world. So if you go to investwithcattani.com, you can find all of that there. And I would love to chat with anyone.
Awesome. Yeah, put the links in the bio for sure. And I don't know if you was talking to Jason Wright recently, and he's a big proponent of the video lead magnets.
He's leading the charge on my new lead magnet build and design. So yes, I absolutely love Jason.
Yeah, he's awesome. I remember I was blown away by what he was telling me. I met him at the same time I met you, the same little cocktail party at Hunter's event last January.
That's right.
And he was just telling me all this stuff that's like, okay, I've never heard any of this before. Like, this is all new. It all makes perfect sense. And it's just like, yeah, he's the GOAT on this, Jason Wright.
Oh yeah, he is.
Awesome. Well, Jonny, thanks for coming on the show. It's amazing to have you back, and excited for our next episode next year. You, Jonny, and everyone listening, keep making milestones.
Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.
The information provided on this podcast is intended to be educational and informational only, and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.